Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Thursday morning, a bit more excitement in the air with the possibility, just the small possibility, that we are once again closer than ever before to ending the war in Iran. So that's what got the street excited, and that's what we will begin by talking about. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, hi, morning.
Hi, good morning. For the Indian market, crude prices are down, and that's a positive. And the RBI has moved decisively on the currency, so that itself is a positive. So yesterday, we had that big intraday recovery which took place, and perhaps there is some steam, there is some headroom for that momentum to carry on today.
Well, that's right. This market has become into a bit of a buy on dips basis. But today, we are faced with another problem that's likely we're going to gap up, so we'll have to sustain those gains. Let's see how it goes.
I said small possibility of getting closer because market latched on to one or two lines, but I think the full court is slightly different. I'll tell you why. So let's just start from the top. Oil prices were down 5% last night, and we ended at 100 and we were about $105.5 or so. So 105 is a lot better than 110. All right, oil relief impulse across asset classes. S&P was up 1%, Nasdaq was up 1.5%. Of course, it's largely led in the US by, once again, semiconductor, chip, AI, that kind of theme is what did the heavy lifting across the board. But, bond yields had spiked, that energy shock leading to the 30, the 5, the 2, the 10, everything going up. And all of that, the entire curve moved lower. The 10-year was down 9 basis points. We're back at about 4.6%, 4.58% or so. And this is the comment which markets latched on to. Trump said that Iran peace talks were in the final stages, which is what led to this oil repricing. That's exactly the quote, final stages in quotes, right? But if you look at the full statement of what he said, it kind of is meaningfully different, you would say. But of course, the narrative took hold because the market wants to believe that this is closer, and it's true, it's entirely true. But it was true any time in the past as well, that they're closer to kind of resolving this. I'm just saying, every time this happens, markets get very excited, and then, there is a bit of a walk back which happens. So let's not fall for that. I'm not saying that this is falling for that, but basically we've seen this many times before. The full quote will come up on your screen, and I think that is what will I think put the entire thing in context. He said economic numbers are phenomenal. We are in final stages of Iran. We'll see what happens. Either have a deal or we're going to do something that are a little bit nasty, but hopefully won't happen. Right? Well, that's the full quote. Now, he's saying, of course, final stages, but he's then saying, well, some of the other unpleasant stuff as well. So we'll see which way it goes. Obviously, everyone wants this to wind down, and markets will rejoice, and you'll see. There's so much shots in the system here that itself can lead to a meaningful push higher. But it's got to happen. That's the only point I'm making. That we need to pay attention to. Okay, now FOMC minutes, and this is the thing. Yesterday, if it were not for these comments, the FOMC minutes perhaps would have been the driver. So geopolitical headlines kind of overshadowed what was happening with regards to the FOMC. The minutes were hawkish at the margin, and the minutes basically showed that the committee, the Fed, is moving away from the easing bias. And I think it's kind of being accepted now that perhaps there is a bit of inflation afoot, which is not going away on the core side easily. Gold and silver, gold, silver should have been lower, but they were higher if rates are going up. But gold was up 1.5%, silver was up about 3.5%, or 3.1% as well. NVIDIA reported numbers came through post-market hours, post-close, the record revenues, and a lot of detail there, but maybe the sales forecast perhaps a little disappointing because, it's such a big performer, not lately, not this year, but over the last couple of years. So the stock in after hours, I think the last I checked was a little lower, but we'll see. And of course, the other one is SpaceX, which is going to be a huge bumper IPO. They filed. They're going to come under the symbol SPCX. That's the symbol for SpaceX. And they disclosed quarterly revenues of $4.7 billion. By the way, OpenAI is going to do a filing, I think, in the next couple of days as well. So we'll see. But some of these large, actually at least three, Anthropic, OpenAI, and SpaceX, all lined up towards the end of the year. That's the picture. GIFT Nifty gives you a sense of how we're likely to start. I think there is a bump higher. And the levels are still the same. Sorry, just to kind of wrap up the levels. They're not different. We need to take out 23,800 on the upside. Past that, we will start to see if this is really turning. It feels that there is a bid at lower levels. The market's refusing to stay down. We've seen that last 2 or 3 days now. But we need confirmation, and for confirmation, we need 23,800 to be taken out. Support is about 23,300 or so. GIFT Nifty, I think, is up 100 plus points, 130 odd points to start the day. Nigel has walked across the wall, F&O positioning, and the stats there. Nigel, take it away.
Well, the troika is favorable actually for the Indian markets today because the yields, Brent crude prices, and the dollar index are softer than what we ended up yesterday. So the troika is in favor. And yesterday, post-market hours, the RBI announced $5 billion of swap to inject liquidity, durable rupee liquidity into the banking system. Now, since crude oil prices have spiked, it's brought inflation concerns back on the table. So it appears RBI could be relying more on liquidity infusion measures while keeping the policy more or less on hold or keeping policy more or less stable. So that appears to be one move. The other factor that we're going to be tracking is the Indian rupee. Yesterday, everyone thought 97 is going to get taken out, but it didn't get taken out, marginally so. But you'll want some kind of stability. It can't continue on a day-to-day basis, depreciating by 10, 20 paise or thereabouts. So today, you'll want some kind of stability on the Indian rupee as well. And that will be a big sentiment indicator. Keep an eye out on that factor. What did the FIs do? Well, in yesterday's trade, they went ahead and they added some short positions. On index futures, close to 6,000 contracts on the short side. The short positioning continues at around 88%. On stock futures as well, you can't just look at the stock futures data. You need to team it up with what happens in the cash market. But they added more shorts than longs, close to around 2 shorts for every 1 long position. However, what we saw yesterday was that they wrote more puts than calls, and that's heartening to see because the markets have been moving to lower levels, and we have been seeing that put writing is coming back into play. In yesterday's trade, close to around 90,000 contracts were written. That's put contracts in comparison to around 50,000 call contracts. And the individual strikes as well should come up for you on the screen. The 23,500 call, the 23,400 put. Both of them saw a fair bit of open interest build up. And just take a look at this 23,400 put. Very, very important. That's giving you a sense that the bulls believe they're in the game because there was writing yesterday. The premium has come down to around 100 rupees. And we have that reference point on the downside. Every time the market has gone to around 23,250 to around 23,300, we've seen a good bounce. And sometimes we don't have any real reason to believe that we'll see that bounce. But that appears to be a bit of a buy zone. So that mark on the downside becomes very, very important. 23,300, 23,250. On the upside, today we're likely to start off above the 50 DMA. You'll want to conquer this mark decisively on a closing basis because the last time around earlier this week, we went to this level, it got rejected. This needs to get taken out, and then all eyes are close to around the 24,000 mark, where you have the 20 DMA that's waiting for you as well. So we'll have to keep an eye out on both those two levels on the upside. The tech index, that's moved beautifully in the last few trading sessions. And yesterday, what happened was it's taken out, the 20 DMA. So it marginally ended high above the 20 DMA. You'll keep an eye out on the 50 DMA that's close to around 500 points away from where it closed off yesterday. That's going to be one of the other indices to watch. And finally, as I've been mentioning over the last few days, the headline index, that's the Nifty, appears to be in a bit of a consolidatory phase. But from the broader markets, individual stocks have come down. Some of them valuation have become pretty okay. And bulls continue to look for opportunities out there. So keep an eye out on the broader markets because even in yesterday's trade, when we started off, there were only 500 stocks that were advancing. When we ended up, it was around 1,500 stocks. And I expect to see more of the same with regard to the broader market participation as well. So that's going to be an important cue. Net, GIFT Nifty suggests a 100-point gap up. You want to take the 50 DMA and you want to build on to those gains as well.
Got that. Thank you very much for that. Let's get to the latest on what Donald Trump had to say. As he departed for the venue, he once again told the reporters that a deal could take place within the next few days. Listen in.
The only question is, do we go and finish it up, or are they going to be signing a document? Let's see what happens. Iran have a nuclear weapon. That's all. It's very simple. We will not let that happen. And we have great support. You wouldn't know that by reading the fake news, but we have great support. People don't want them to have a nuclear weapon, and they will not have a nuclear weapon, and they want to make a deal so badly. We'll see what happens, but we hit them very hard, but we may have to hit them even harder, but maybe not. But we're not going to let Iran have a nuclear weapon and blow up the entire Middle East, Israel, the entire Middle East, and then come here for you.
Very, it's right on the borderline, believe me. If we don't get the right answers, it goes very quickly. We're all ready to go. We have to get the right answers. It would have to be a complete 100% good answers. And if we do, we save a lot of time, energy, and lives, most importantly. Could go very quickly. Or a few days. It could be a few days, but it could go very quickly. Iran is a defeated nation. We're dealing with some people, and we're dealing, actually, I must tell you, we're dealing with some very good people. We're dealing with people that are, I think, far more reasonable than the people that are really no longer with us. Hopefully those people will make a deal that's going to be great for everybody. If I can save war by waiting a couple of days, or I can save people being killed by waiting a couple of days, I think it's a great thing to do.
Drew Pettit, Director, U.S. Equity Strategy, ETF Analysis, Strategy Research at Citi, now joins in. Drew, once again, there is hope in the air. Final stages of perhaps with the conflict with Middle East. How different was Donald Trump's statement? Because we've heard this narrative before. Markets have gone up, but we haven't had a resolution. Did you find what the markets latched onto very different from what we've heard in the past? Are we really closer to the end of the conflict? What's your own assessment of the way the markets reacted yesterday?
Yeah, look, I'm going to take cues from the oil market and our oil analysts here. And we still think the markets are not pricing in enough tail risk here, where there is actually a longer duration of conflict. So right now, we actually still think Brent crude can be something more like 120 near term with a, I guess, bull case for the commodity, which would be a bear case for risk assets up to 150. So not quite sure we get the all clear yet. And honestly, we'll see it in oil first, and then the follow through and reaction will be in equity markets globally.
But there's, Drew, hi, morning. What about the final stage comment? So I was looking whether, so we put out the full comment to what he said, right? But of course, I mean, the market latched on to that final stage. Perhaps it could be the final stage, perhaps not. How do you read it, Drew?
Yeah, it's funny. The market definitely took it positively because you saw the cyclicals react more aggressively. When I looked at the action in the U.S., the small caps outperformed. Anytime we have concern around economics, inflation risk, interest rate risk, all stuff that's basically tied to Iran conflict, it feeds through most aggressively in cyclicals and small cap. That rallied the most in the U.S. But at the same time, the market was also giving you a separate signal because it still rallied the mega cap growth names, which are the most relatively insulated to geopolitical concerns. So you got the NASDAQ outperforming, the same time the Russell outperformed. That's a little bit of the market actually hedging itself, saying, yeah, we might be closer to the end than we were before, but we still need to see it. We still need to take oil down further for, I would say, the cyclical assets to continue to outperform like they did at the beginning of the year.
There are lots of people who are now saying, and I don't know if this is, it's not an exact science, but I think yesterday we had, JP Morgan's India economist, and he looks at ASEAN research as well, saying JP Morgan internal global view is that even if the war were to end now, their oil price forecast is 100 plus for the rest of the year. Now, I don't know. Any thoughts? What's the Citi view here?
Yeah, the Citi view is long-term. We're probably not going back to 60 or 70 oil when we look out to 2027. Our commodity team, like they're looking at $80, $90 oil into next year. They don't think we reset all the way back down. So again, input price pressure to cyclicals. That's why NASDAQ is much closer to its all-time highs again, even after a few days of profit taking, than the Russell is. So it's much further down from its peak. So again, US small cap, the reaction function to cyclical risk, US mega cap growth, that's kind of your relative safe haven that people have been trading. Again, the earnings story in one pressured by higher oil and inflation, while the AI story still real and less pressured by geopolitics and I would say real economy concerns.
All right. Hi, Drew. Good to see you, Vince. So you still believe that we are in an AI boom and not an AI bubble, as you had told us a few months ago? And also, have you had a look at NVIDIA's numbers? Any quick comments out there?
Yeah, look, still to us, it's boom over bubble. You're seeing it play out in more stocks now. Again, like we've talked about chips, we talked about NVIDIA again, upside versus street expectations, a little bit more clarity on the guide, which is all very good for the story. But you're seeing a lot of the infrastructure names in the industrials continuing to work and outperform. You're seeing memory names, not just in the US, but in South Korea, Taiwan on the semi side, like working. So the fundamental narrative there, it's still good. We're still believers in it. We're absolutely happy to buy AI and earnings momentum still.
Drew, we were just having a chat with one of our experts yesterday, and he's bullish on the entire AI theme. He's riding it very aggressively. But he said that when these three large IPOs come to the market, it will be a litmus test. That's OpenAI, SpaceX, and then later Anthropic. Now, we got the SpaceX prospectus. Now, they're looking at a revenue of about $18-19 billion last year, but they're asking for a valuation of $1.75 trillion. That's what reports seem to suggest. Do you think at some point, these large IPOs, when they come to the market, could in some way moderate the excitement, prick the bubble? Not the bubble, but prick the enthusiasm?
Yeah, people have to make room in their portfolios for it. I completely get that argument. But you got to remember, we haven't had very much equity supply and really like interesting IPOs over the years. So there's a lot of I would say kind of pent up euphoria for this. Our teams here have done studies that normally when you start to see equity supply coming, you still have a few more months where price action is still pretty good. So again, just put it in context. These are massive IPOs. You can't really compare it to any point in history because of how big they are. But at the same time, equity supply has been really constrained for a lot of years. So a lot of pent up demand.
Yeah. I don't know, Drew, on that point, right? Paul Tudor Jones, in an interview recently, made the point that, he compared basically the quantum of buybacks on average in the US and the new supply which is coming through. And he says, well, it's mismatched, but we'll see where this goes. On EMs, what's the view, Drew, for oil importers which have been hurt recently, like India? Any thoughts?
Yeah, look, we took EM down to neutral in our global allocation. India and a lot of the cyclicals like Mexico, Saudi Arabia, Chile, they've been taken to underweight within the EM allocation. We're really leaning in on this narrowing thesis around technology. So the overweights in EM, again, Korea, Taiwan, and then I would say differentiated story in South Africa.
So, sorry, just go through that again, the EM list? In terms of
EM,
yeah.
Overweights, Korea and Taiwan around the narrowing into the tech trade. We're also overweight South Africa within our EM allocation. And on the underweight side, India, Saudi Arabia, Mexico, Chile.
Since you mentioned Mexico and the United States obviously in focus, do you think Trump will want to end this entire war before the World Cup starts?
No comment there on the World Cup, at least here. My team probably not in it, to say the least, being a Canadian here. But it's hard to tell. Again, I'm going to go back to what we were saying about oil. We still don't think markets have really priced in longer duration of this conflict. It's a little bit tricky. Yeah, everyone would like to see this over with. I'm sure politically, no one wants to be talking about this into elections in the midterms in the United States as well. But at the same time, two sides to this. It's a much more complicated situation than a lot of us really can get out of the headlines.
I just thought I'll ask you, because yesterday there were some reports talking about room cancellations and not too much traffic out there. So I guess Mr. Trump, being the businessman he is, he would like to have a full-fledged World Cup.
Well, Drew, just a quick point on the new Fed chair, right? What's the immediate impulse as that sort of, the market says, well, we've got a new guy on the head of the Fed, and where will we see this in a more pronounced way? Which asset class?
Yeah, look, rate volatility is where you're going to see it first. And right now, I hate to say it, it's like the Kevin Warsh of the Fed story is like a back burner. Again, oil inflation concerns, that's driving everything. From an asset allocation perspective, we're not really worried about real rates moving higher. I guess you can kind of read that through to saying like the Fed controls the real rates. It's the inflation story and inflation expectation story that's really driving the broader U.S. rates higher. So, yeah, new Fed chair, but look, all eyes are still on Iran. All eyes are still on oil. We really think that's the driver to, I would say, the other asset classes and risk assets and global equities right now.
Drew, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. Thank you. Well, let me just quickly run you through the interactions which are lined up on the program here. 8:35, we've got the management of Metro Brands joining us on the fourth quarter numbers and the outlook going forward. 9 a.m., Abneesh Roy of Nuvama Institutional Equities discusses the trends in the QSR space. 9:20, Ashwini Agarwal of Demeter Advisors will be a market master of the day. 9:30, IRB management joins in. Apollo Hospitals after that at 9:40. We also have the management of Samvardhana Motherson joining us at 9:50. So it's a full earnings deck coming through. And of course, Sammaan Capital reported numbers, and there are some interesting details there. So Gagan Banga at 10:15 joins us.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. But we're looking at Apollo Hospital, Jubilant FoodWorks, Bosch, Metro Brands, International Geological Institute, AB Capital, JSW Energy, as well as BEL. All of them will be reacting to positive news flow, while Sammaan Capital and IRB Infra will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. It's time now to talk stocks. Our research team is standing by with CNBC TV18's list of top stocks for the day. Let's address Apollo Hospitals. That's the Nifty company which came out with numbers yesterday. Ekta joins in with her read. Ekta, hi, good morning.
Morning. Well, yes, for Apollo Hospitals, it was a good set of numbers which came in. So the revenue beat estimates. It was up around 18%. Street was anticipating around 15% growth. Margins 15.3. The Street was anticipating 14 to 15% margins. And the profit was better than estimates as well. Before I get to the details with regards to the numbers, there is an important update from the company where they will be merging their maternity and fertility brand Apollo Cradle and Fertility with Cloud9. So this entire vertical of Apollo's is valued at around 1,550 crores. They will be holding close to 10% in the merged entity. Now, the hospital business margins, coming to that, was lower, down around 43 basis points year on year due to losses of around 41 crores from their new units. The occupancy at hospitals was up around 100 basis points on a year-on-year basis, which is positive. The GMV for Apollo 24/7 was positive as well. It was a 20% growth on a year-on-year basis in Q4. So overall, the statistics looked largely good. It's only the new hospital business as well as the merger of this new entity is something that the Street will be watching out for. Net, I expect the stock to be in the green.
All right. Thanks very much, Ekta. And as I said, we have the management join us a little later. Jubilant FoodWorks is the next one we're going to focus on. Mangalam is here with details. Mangalam, take it away.
Well, for Jubilant FoodWorks, what wasn't good was already in the price because the Street had anticipated that. The company had given their fourth quarter update. So the remaining reported numbers are actually above expectations, and that's as far as the EBITDA is concerned. So the revenue grew about 6.5% on a standalone basis. We were working with about 1,680 crores. That's what the company reported. But the EBITDA, that came in at 344 crores. The Street was working with a number of 305, 306 crores. So it was an EBITDA beat as against the consensus. Net profit was lower because of a high non-cash expense, which is depreciation, because of the higher store additions that the company has done as well. Delivery channel, that grew at about 10.3%. That accounts for nearly 76% of their sales. So delivery is doing well for them. They maintain their medium-term guidance of 5 to 7% like-for-like growth. Remember, this 0.2% growth that the company is reporting in the first quarter is on a 12% base. So year-on-year, it is actually between 5 to 7%. Q1 FY27, they've said that the like-for-like growth is better than the fourth quarter. And there will be near-term margin pressure that will be visible. But long-term, they maintain their margin guidance of 200 basis points improvement, going with mild green on Jubilant FoodWorks.
Got it, Mangalam. I want to ask you the next question, but we'll expect a treat during the course of the day. You know what that is. Going to Ria. Ria, tell us about BEL.
Well, good morning. BEL yesterday in its earnings call has given a lot of important commentary. First up, they have given guidance for FY27. Revenue growth is expected to exceed 15% for the year, with EBITDA margins also expected to exceed around 28% for the full year. In terms of the order inflows, they are expecting order inflows in excess of 55,000 crores for the full year ahead, with the current order book standing at roughly 73,882 crores. For the export order book, currently it is at nearly $500 million US, and this is expected to increase significantly over the next 2 to 3 years. And they are also expecting exports to be roughly 10% of revenue over the next 4 to 5 years. In terms of the QRSAM project, which is the Quick Reaction Surface to Air Missile, this is expected to be around 30,000 crores, this order, and this was expected to come in FY26 itself. But now the company is expecting to sign this order by June or July, and the proposal is currently awaiting the final approval from CCS, and following the contract signing, the first production model is expected to be delivered within 18 months. So that will be a big boost for BEL once this order is signed. And overall, the company had reported a very good set of numbers in FY26. This was on Tuesday. This was largely in line with estimates and the guidance that the company had given. The revenue saw a growth of around 16% for FY26. This was in line with the guidance that the company had given. Margins are standing at around 29% for the year, exceeding their guidance of 27%. And overall, we have seen very healthy execution in Q4 and FY26 as well. And today, the stock is expected to open in the green on the back of this positive outlook for FY27.
Thank you very much for that. Over to Sudarshan now for Bosch.
So Bosch has come out with the earnings which look largely in line. Revenue was driven by power solutions. That has grown by more than 27%. Two-wheeler power sports too has seen a growth of more than 63%. Besides, earning companies announced JV with Brakes India and Wheels India for CV segment, and that business JV will start operations by the end of this year, that is 2026. But talking the numbers in detail, profit has increased by 2%. Revenue has seen a growth of 13%. EBITDA too has seen a jump of 21% to 782 crore, and margin has come in at 14%. Two segments, mobility business that forms almost 85% to total revenue. That business has seen a growth of 23%, and another business that is consumer goods, for that revenue has seen a growth of almost 14%. Stock has seen a huge run up in last few months, so I'm going with light green.
Got it. Okay, all right. Thanks a lot for that, Sudarshan. Hopping across to Ananya, she's here to tell us about Sammaan Capital's numbers. Hi, Ananya.
Well, very interesting quarter for Sammaan Capital. We can say it was a more of a reset quarter that could redefine the franchise. Now, when we look at the numbers, they reported a loss of around 8,000 crore after aggressively cleaning up their legacy book through ARC sales, write-offs and provisions. Now, NII also remained weak. We can see the finance cost of nearly 16,079 crore exceeding interest income of around 1,000 crore. But the management mentioned that this will be the end of the cleanup era. Now, backed by $1 billion IHC's investment, Sammaan Capital now claims that their 53,000 crore AUM carries effectively no GNPA or NNPAs, and all the three rating agencies have upgraded their rating to AA+ within 50 days. Now, the big story here, the main catch here is the cost of fund. The management expects 150 to 270 bips reduction over time that could gradually improve the profitability going forward. Now, when we look at the guidance, they remain very aggressive. Targets of 2 lakh crore AUM, 4.4% ROA, and high teen ROEs by FY30. And while the few quarters will be very critical for proving NII recovery and sustained profitability, the management message is clear that the worst is now behind them, and we can see if the execution remains disciplined, Sammaan Capital could emerge as one of the more interesting long-term turnaround stories in the NBFC space.
Thanks very much for that. That's going to be an interesting one later today. Metro Brands, and International Gemological Institute also came out with earnings. And back to Mangalam. Mangalam.
A good performance from Metro Brands. 20% revenue growth, 20% EBITDA growth, 23% net profit growth. Goes down as a good quarter. They added 42 stores during the quarter, 124 in FY26. More importantly, they opened two new Fila stores in Q4, and that's going to be a growth driver for the company. E-commerce has done well for them as well. 53% growth is what they've seen out there. It accounts for about 12% of their sales, going with green on Metro Brands. International Gemological Institute as well. Nearly 21% revenue growth led by high volumes in LGD segment. EBITDA grew by about 21% as well, and the net profit grew by 27%. Certification volumes for the quarter were up 16%. The rest of the revenue growth came in from realization, so that's a positive. The only negative here is that natural diamond did not grow as much as lab grown. So that's something that we will quiz the management on.
Thank you very much for that. 10% natural growth, lab grown up 33%. Sudarshan now joins in to tell us more about AB Capital.
So we told you on May 15th, and now that news break has got confirmed. Board of AB Capital has approved the promoter infusion of 4,000 crore, and that infusion will be done by Grasim Industries, Suryaja Investment. These are Aditya Birla Group companies and International Finance Corporation. So Grasim and Suryaja will be infusing 3,080 crore, and International Finance Corporation will be infusing 920 crore rupees. So Jeffrey has come out with a note, maintains buy call on the stock, target price is 425. It believes that on standalone NBFC business, equity infusion should be 2% EPS accretive and 11% BV accretive. Standalone Tier 1 capital should rise by 15.7% from the current level of 13.8%. I'm going with green.
Thank you very much for that. More fundraising for JSW Energy. There is news on IRB Infra. Vivek now joins in.
Well, that's right. Just a couple of days ago, you did see JSW Energy pair part of its holding as far as JSW Steel is concerned to raise gross proceeds of a little over 3,100 crore. Now, today, the company has gone ahead and launched a QIP to raise close to 4,000 crore rupees. The indicative issue price is at a minor discount of a little over 2% to yesterday's close, and it's in the range of 525 to 527 rupees a share. Equity dilution of a little over 4% for this particular fundraiser. Now, remember when the management joined us on May 12th, they said that they had taken an enabling provision to raise up to 10,000 crore rupees, and the nod was there or valid up till December 2026. So again, fundraising, and this should help debt levels go down after what was a disappointing Q4. Now, coming to IRB Infra, there's a very perplexing update that the company has given to the exchanges. The company says bank guarantees submitted for two L1 Maharashtra State Road Development Corporation projects has been returned by the agency. Now, these two projects were for Nagpur-Chandrapur Super Express highway packages, and the total value of these projects was over 4,100 crore. Now, why is this important? Number one, the company has decided to remove it from its order book. The order book at the end of Q3 stood at over 13,000 crore. So it's a significant debt as far as the order book is concerned. And what the management has indicated to the exchanges is that they have asked for a reason as to why this particular L1 position has been cancelled. They have not received any from the agency.
Thank you very much for that. Let's go across to Manisha now to get a handle of what's happening in the world of commodities. Manisha, hi, good morning.
Morning, and thank you for that. I'll start with the crude oil prices, where we have seen 5% of a decline in the overnight market. This is after U.S. saying that they are nearing a final phase of negotiation with Iran. Iran says that they are evaluating the U.S. latest draft response to its 14-day proposal therein. The satellite data also shows that the three supertankers did pass through the Strait of Hormuz, and that also has eased prices a bit. But then again, we are still holding above $100 a barrel, and ADNOC said that full recovery in the Middle East oil flows is unlikely before late 2027. So that will keep the prices in that 95 to 105 range therein. But the decline in crude prices definitely has worked well for the metal prices. Gold gained 1% overnight. Silver was up by nearly 3%. Copper prices gained up by 2% as well. The peace agreement between U.S. and Iran could ease inflationary pressures, and central banks perhaps will not need to tighten monetary policy, is working in favor of metals at this point.
All right, Manisha, thank you very much for that. We'll take a quick commercial break here. Our first management of the program, Metro Brands, joins us on the fourth quarter numbers and the outlook ahead. Stay tuned, coming up.
Welcome back. As promised, let's go across to the management of Metro Brands. That's the first management on the show. They reported actually a very, very good revenue growth, which jumped up close to around 20%. If I'm not mistaken, I think that's the highest growth we've seen in the past 12 quarters. To understand what's the way ahead, we're joined by Mr. Nissan Joseph, the CEO at Metro Brands. Hi, sir. Good morning. Good to see you in. You know, in the past, we've spoken about your revenue number compounding, I think, in mid double digits is what you have spoken about. And EBITDA margin targets has been around 30%. For the coming year, what do you expect in terms of growth? 15-20% seems gettable?
Well, I think, there's the tailwind of the economy rising, and we have the tailwind of premiumization going on, along with the fact that we've got multiple banners that caters to different segments of the Indian population. However, as we all know, there's a crisis going on that we're trying to also make sure that we're ready for, to mitigate any near-term input costs that may come up. And, I think we're prepared for the short term at least. But overall, I think on a long-term basis, Metro has always delivered mid double-digit growth in the team. And our EBITDA continues to come around 29 to 31% mark. And that's a guidance we're pretty comfortable with for a period of time, Nigel. It's not always every single quarter, but
So you're saying in terms of growth, mid-teen growth, and in terms of margins, holding around 30% odd should be gettable, right?
That's always been what we do. So
got it. I just want to ask you, in India's, earlier used to do, I think, around 23-24% margins, which has come down to around 20%. So no worries on growth, but some analysts track that particular factor. So could you tell us what is the guidance on that basis?
Yeah, so I think, when you say pre-Ind-AS, you mean before taxes too, right? The PBT, right? So that continues to will hover around 20%. It gets affected by the number of new stores we have because of the Ind-AS reporting that we do. I think a better measure for our growth and looking at our profitability of operations would be the EBITDA number, which has, outpaced our revenue growth almost consistently and has held in that 30% range. We don't see any fluctuations to that. Our gross margins have held up through the quarters, and we see that continuing as well.
Mr. Joseph, hi, morning. So you mentioned this conflict right now. In what way is it impacting you? I mean, you've got 1,000+ stores. One thing we've heard from many companies, not many, but at least a few, is some labor shortages. People not, is that something you've seeing at your at your stores as well?
I think, Prashant, there's a number of factors that come into this, right? One of them is input costs are going to rise because a lot of the products we deal with have petroleum bases to them. So that's one. You have freight costs that continue to, go up because of petroleum as well. Then you also have the fact that, there's revenues of expatriate money coming back into the country that's going to be affected. Overall, there's going to be some effects to the demand in the country. Having said that, though, we weathered the COVID storm better than any other company out there, having posted a profit during the COVID year. And we're taking some of the same very similar steps to ensure that, there's business continuity without seeing any spikes in our operations, whether it be in input costs or whether it be in other costs related to it. So, we prepare for the worst and hope for the best.
Is there any pricing? Do you take price? There must be some regular price adjustment higher every year. So because of what's going on, the input price pressures, etc., is there a price hike afoot, or have you already taken it? So what you're telling us in terms of margins and growth, etc., is accounting for this price increase?
So when we buy products, 6 months out in advance, right? So we get prices for today for 6 months out. You're not going to see any immediate price increases. You're going to see the normal inflationary price increases, nothing out of the ordinary. But a lot depends on how long we see this inflated costs of oil and other input costs. So overall, though, I feel confident that if we do have price input costs rising, we'll be able to offset that with, price increases across certain sectors in certain markets. So, it's not going to be detrimental to our business in total. But at the same time, when there's short-term winds blowing, you got to watch for those.
Just some numbers. The same-store sales growth in Q4 and FY26?
What we guide to REMA is actually an overall growth percentage, which we target about 15%. And you can assume that, somewhere 30 to 40% of it comes from same-store growth, 30 to 40% comes from new stores, and then you get the rest from the annualization effect of stores that were opened in the previous years, right? So loosely, that's how we disclose our numbers. Overall, though, I think we'll continue to see our business grow in that teen range. There's no reason for us to believe that, barring something unusual, which, of course, there's always that possibility, but barring something unusual, we should be on track for that.
Okay. Of course, you've been maintaining that very consistently. What about the target store additions for FY27 and e-commerce? How much do you think it will contribute to your overall top line by the end of next year?
So, what we've seen from a new store opening perspective is last year we opened a net of 124 stores. I believe it is 140 odd stores, but as retail progresses, you close out stores or you relocate stores, right? So, but 124 stores were opened, crossing the 1,000 store mark, which is one of the highest number of openings we've had as a company in our history. And that's followed by the previous year where we also had a significant number of openings. So we're going to see that there's growth possibilities because we have multiple banners. But at the same time, Rima, we're not going to rush to open stores and hit a target and open stores for the sake of opening stores. What we want to do, as you've seen, is open profitable, meaningful stores. And that wherever that opportunity presents, however much that is, thanks to the fact that we have adequate capital to support us, we'll be able to open as many stores as we feel is correct for the market.
Okay. And e-commerce, how much will it contribute?
E-commerce, was at 10% a couple of years ago. It's now risen to 12, and we anticipate that continuing to grow. The good news is it's not coming at a cannibalistic level of taking away sales from our brick and mortar stores, but it's going to hover between 12 and 15% in over a period of time. There's quarters it'll touch 14%. There's quarters it'll touch 12%. One thing I do want to point out that last quarter was the quarter that we're talking about is an end of season sale quarter, and the fact that we've been able to maintain margins and grow not only the e-com business but also a brick and mortar business is commendable given the state of where things are in the economy in general.
Final question before we let you go. I was looking at operating cash flow. That came down a little bit in this year, though your growth has been pretty strong. That's because inventory days have spiked up as well by, I think, around 15, 18 days. Where does this number settle in at?
Yeah, so, when we look at the future, we're buying for stores that we're going to open in the next quarter, right? So it's not always just for your operating business. We have a number of new banners. And as you mentioned earlier, we opened 2 of our Fila stores. For growth, you need excess inventory. You need more inventory than your normal day-to-day operations. So that's number one, And then secondly, as I mentioned before, we do plan on carrying some inventories from time to time in excess of what we need if we anticipate spike hikes, if we anticipate certain disruptions coming to the business. So it's a combination of all of those things. Typically we want to run about 2 times stock turn. So we need about 6 months worth of inventory to run a healthy business.
Okay. Pleasure speaking to you as always, sir. Wishing you all the very best. Hopefully things improve on ground. For the time being, you're sounding very, very optimistic about this fiscal, and we wish you well. We'll chat up soon.
Thank you.
Let's get in Deepan Mehta, then Director Alexa Equities, who joins us on the show. Hi, Deepan. Good morning. Good to see you. When it appears the global equity markets seem to be in a bit of a better place, so hopefully the end of this war is nearer rather than further. That said, what do you make of the management we just spoke to? Metro Brands talking about mid-teen growth, margins holding at around 30% pre-Ind AS. It should be around 20% or thereabouts. And they're saying that store openings as well will take place. Your view?
Good morning, and thank you for having me on your show. I think a very confident management, and I think after a couple of soft quarters, we are seeing the company resume its kind of growth rate, which is expected to be the mid-teens. Really one of the quality specialty retailers, as I would classify them, and perform much better than their peer group companies. But at 65 times or so, trailing 12 months, a lot of the positives have been discounted. So if I'm an investor, then I would remain invested. But from a fresh investment perspective, considering that you should account for a softer couple of quarters, that operating profit margins also will be under stress, as also slight dampening of the consumer sentiment, I would say that maybe at correction, there'll be a better opportunity to invest in the stock. But right now, I think seems to be well priced.
That's the call coming in on Metro Brand. What about Jubilant FoodWorks, Deepan?
I think similar for Jubilant FoodWorks as well. And companies are kind of a similar returns profile, profit profile, growth profile, and similar valuations also 70 times or thereabout trailing 12 months. And, buying stocks 60, 70 times trailing 12 months really doesn't give the best possible returns and outperforming returns per se. And even if 1 or 2 stock quarters come, then the stock tends to correct and go sideways. In my experience, I think to buy these stocks is when they are really in a soft patch. when the returns, when the numbers are disappointing, where year-on-year, quarter-on-quarter growth rates have slid, same-store sales growth are disappointing, that's the time to get into these companies because eventually they are great long-term compounders. It's just that don't want to buy them when they're at a high, when they are that mild upcycle when it comes to their earnings. So it's better to buy them when there is stress in the company and stress in that particular stock. And that gives, I think, better returns and provides at least some amount of margin of safety. At that point, the PE may look even more expensive, but then the long-term growth, will kind of neutralize that expensive PE multiple.
Got it. Okay, Deepan, request you to stay with us. We've got lots more questions for you. For the time being, slip in a short break, come back, continue our chat with Deepan. We'll also be joined by our technical experts. Stay with us.
Welcome back. Still in conversation with Deepan Mehta. Deepan, lots of stocks came out with their earnings yesterday. You want to highlight any which got your attention?
Yeah, what I see on your screen, Apollo Hospitals, a company in which we and our clients are invested in, and really, I think, fantastic set of numbers, operating profit, operating leverage playing out very well. And I think the productivity has also improved significantly. The assets are yielding the highest ever revenues and profits, and the split which they are doing will be highly value accretive for minority shareholders. So this is one company, which I think has performed very well and they were given very good returns and continues to surprise. And it's a nice, I think, great compounding story. The business also is such that, healthcare spends are going to be priced in a secular manner. And intelligently, they are expanding their capacity. I think in the next 2-3 years, a lot of new hospitals coming on stream that may depress the margins, but will ensure long-term growth.
Got that. Deepan, stay with us. We just want to address one global name, which is going to, we'll see if it rockets higher or not. I'm talking about SpaceX, Elon Musk's SpaceX, which has officially filed its IPO papers with the SEC. And they're going to list on the NASDAQ. Hormuz is here with, interesting stuff out of that filing. Hormuz, take it away.
It was a very long filing to go through, Prashant, but it was the much-awaited, the much-anticipated SpaceX IPO, most probably having a listing next month on the NASDAQ in June, and the roadshows are going to kick off from the 8th of next month. And they've also mentioned that they will be listing under the ticker of SPCX. And based on their last valuation, when they had merged xAI with the company in February of this year, SpaceX was valued at over $1.2 trillion. And if you take a look at the financials as well, they operate in 3 important businesses: space, connectivity, and AI. And majority of their revenue and the operating income comes from the connectivity business, and that's the only profitable vertical of the company right now, with both the AI business and the space business losing money. The space business saw losses of $657 million, and the AI business lost almost $6.5 billion in 2025. In fact, in the first quarter itself, SpaceX lost around about $4.5 billion, nearly the same as what they earned in terms of revenue. Now, the Starlink, of course, falls under the connectivity business, and the AI business includes Grok, X, and xAI, which they merged as well. Now, among the key risks that they have highlighted in the IPO, they've mentioned that the entire growth strategy depends on Starship achieving commercial viability, and if that does not happen, then no satellites will be launched and the financials will be under threat. And the fact that the plan that they have of deploying AI compute satellites in the sun synchronous orbit by 2028, that is based on technology that is not yet available or commercial, is what SpaceX has said. The AI business faces regulatory risks, the losses are mounting and they are persistent, and they have debt worth around $29 billion, of which $21.5 billion is maturing as early as 2027. So there is plenty to watch out for. SpaceX, probably the biggest IPO in history, coming next month.
I mean, that's quite something. Thanks very much, Hormuz, for that. That's a big one. We'll have, Deepan, if this IPO is successful, we'll have our first trillionaire. How does that sound? That just sounds wrong.
Well, Prashant, we live in interesting times. How much we have seen last 30 years now, a company like SpaceX coming. And mind you, they are saying everything possible for you not to invest. The kind of risk factors which they have put up. are so fundamental to the success, and they are saying that they don't have the technology, they don't have the kind of persistent loss making in the AI business, and yet I'm sure the IPO will be extremely successful. So I think the thing is that a lot of capital is just chasing these growth stories because the rest of the world there is hardly any growth, and then these companies just get bid up higher and higher.
You know, I just wonder the last set of, if you think about it, right? I mean, the Amazons of the world and Microsoft or Google, etc., and where they IPO'd. I mean, they've been such huge compounders, but they all sort of listed at piddly valuations. Not piddly now, but I mean, whereas all these three large IPOs which are coming now, they've had early investors, a select set, which is ridden all the way from $0 to $1 trillion now, and the IPO now comes at whatever, $1 trillion, or in terms of valuation, right? So you and I, if you have to buy, we're going to be buying at this valuation now. That's the only difference I see. I mean, I've got nothing against any of these, but it's different compared to, those businesses which listed in the late 90s, etc.
Yeah, that's right. I think,
or maybe trillion is the new billion. I don't know.
If I may just say, Prashant, that this is the power of private equity. And sometimes, many times I wish that I was in private equity and not public market, because the entire cream, the cheese is going to the private equity companies. And then what we are left in the public markets is after the company has reached maturity, and then they will grow only at 15, 17% or thereabout. But the 30-40% growth rate period has gone to the private equity investors. Of course, they take a lot of risk in terms of failed ventures as well. But I suspect their returns are far, far higher than invest in public market.
Yeah, absolutely. We've got more stocks to discuss, and Deepan will do that. We'll just take a quick commercial break here. We'll come back, and Abneesh Roy of Nuvama Equities is also going to be with us on the other side on trends in the QSR space. Stay tuned. Okay, welcome back. We've got the technical trades now, and Mitesh and Sudarshan are with us with exactly that. Gentlemen, great to have both of you here. Thank you for joining us. Sudarshan, you go first. How are things looking? And, we start up 100 points, but what then? What do you do?
Yeah, good morning. Well, we are going to start off somewhere around 23,800, which is the resistance in that trading zone where we have been living for the last 15-20 days. Now, the interesting part is not that we are coming back to resistance. It is the fact that for the last three dips that we have seen inside the trading range, each low has been higher. So we have seen a pattern of higher lows. That is interesting. So I would be a buyer today. Now, see, this is a buying done in anticipation of a breakout of 23,800. But then sometimes we do anticipate. Keep a tight stop at 23,650. Use options if you want to be a little more careful, and you should be, but be on the long side in the Nifty today.
Got that. Be long. Mitesh, would you concur? Buy the gap up?
See, I think the only worry is that we'll open around this 23,800 mark. But my sense is that I would want to wait for that hurdle to be cleared. So after the gap up, not immediately, but in case we see follow-up strength and see the Nifty get past 23,800 levels and sustain above it, then yes.
Mitesh, what stocks would you go with?
On the stock side, see, I have a mix of buys and sells today. On the buying side is Memphis with a stop below 2205 for targets of 2315. Grasim is a buy with a stop at 2940 for targets of 3030. And PI Industries was obviously the casualty in the yesterday's market, but can see further decline. So that's a sell with a stop at 2950 for targets of 2800. And ICICI Lombard General Insurance, that's a sell if it breaks 1780, then short with a stop at 1806 for targets of 1730.
And Sudarshan, hi, good morning. What stocks would you go with this morning?
Yeah, good morning. I also have a mixed list. Jubilant Foods is a buy with a stop under 465. Angel One is a buy with a stop under 315. BHL is a short sell with a stop above 420. And Colgate is a short sell with a stop above 2235.
Sudarshan, Reliance made a big move yesterday, pretty much contributed to all of the Nifty up move. Is there more momentum in Reliance?
I would think so. Probably the deep correction in Reliance is over. And while Reliance has always been recommended as a buy on dips positional trade, at this point, there is a reason to think that we can also take a swing trade on the long side in Reliance. Actually, Reliance and the Nifty will do the same thing.
Okay. Any levels on Reliance? If there is a trade someone wants to venture into?
No, the levels are simply that keep wherever you enter, keep a 50-point stop loss and then go long.
Okay, we've got the pre-opening rates. It's in the green. The Nifty is up about 150 points, letting the rates settle in. But Grasim looks like it could continue with the up move from yesterday. Apollo Hospitals could be the big winner in today's trading session. In pre-open, it's up nearly 3.5%. Ekta was telling us numbers look good, and Max Healthcare reports numbers later today, so that should be on your watch list. There are two Nifty companies reporting numbers. One is ITC, and the other one is Max Healthcare. But let's get in Abneesh Roy, who joins in from Nuvama Institutional Equities to talk about Jubilant FoodWorks Q4 numbers and the key trends in the QSR space. Abneesh, thank you very much for joining in. Let's begin with Jubilant Food. Your read?
Yeah, hi, good morning. Thanks for having me. Yes, we expect slight weakness definitely in Jubilant Foods. Our top pick in QSR space will be Devyani. If you see Devyani, clearly the outlook and overall performance in Q4 and even how they see FY27 sounded more positive. So we do see that Devyani will outperform Jubilant Foods in the near term, medium term. Jubilant Foods is more of a H2 FY27 story. Near term, our sense is Jubilant Foods will see some margin pressure because of higher fuel cost, manpower cost, minimum wages, those are going up. And if you see even in terms of growth, Devyani saw, I think, 14-quarter high growth in terms of SSG in their KFC format, while Domino's clearly saw flattish SSG. I think in March quarter, clearly Domino's did suffer because of the gas fuel availability. Also, we saw even in Britannia. So wherever baking was involved, I think in March month, there was a issue of fuel availability. I think in Q1, even Jubilant Foods will see recovery there. But on a relative basis, we'll prefer Devyani over Jubilant Foods in the near term, medium term.
And valuations of Devyani versus the others?
No, I think there is comfort in valuation. Plus, if you see in Devyani, the merger story with Sapphire also over the next 1 year, 2 year, that will the approvals will come over the next 1 year, and then in FY28, hopefully we'll see the merger benefits also. So yes, there is a re-rating potential in Devyani, given the outlook also, what they have shared and what we have seen in Q4 is better. So yes, valuation comfort is there. Jubilant Foods, yes, it has corrected, but given Q1, Q2, there will be some beat on the miss on the margins. We see that the valuation re-rating potential is in Devyani rather than Jubilant Foods.
Okay, all right. Hi, Abneesh. Good to see you in. Abneesh, what about Grasim? You know, Birla Opus, yesterday the numbers look pretty good on the paints front. They're saying that they've gone ahead and they've garnered close to around 90 basis points of market share as well. What are you factoring in for this year? The reason I ask you this is because they're normally clubbing that B2B e-commerce business with paints when they're reporting. So what kind of revenue growth are you factoring in? What kind of profitability? When do you expect this vertical to turn profitable?
Very good question. So if you see this time Q4, almost every FMCG company, Staples, Pidilite, Asian Paint, Berger, everyone is going to see or has given good results. Asian Paint results will obviously come on May 29. You will again see double-digit volume growth and good performance overall. So what we are seeing, definitely even the new player is now part of the overall growth story. Yes, first 18 months they have taken market share, but now if you see pricing wise and even in terms of dealer incentive, they are rationalizing, which I think is the right way, because in the initial part you will be aggressive, but then they do have a Q4 FY28 EBITDA break-even and profitability. So if they have to meet that, they have to go towards a more rational policy. My sense is clearly in FY27, all paint players will see double-digit revenue growth. So even for the new player, obviously, we would expect a double-digit revenue growth, which means in the ballpark 20% kind of a range. But even for legacy players, the growth will be quite good in FY27, which is a marked departure from hardly any growth last 3 years. So even we are quite positive on Asian Berger. Berger, in fact, to play the Bengal new government story is one added advantage. So I would say that this paint industry did see disruption, did see very aggressive competition. My sense is now 25% local competition, they will lose market share. Some of the local and smaller paint players also will lose market share. But I think overall Asian, Berger and new player both will now coexist rather than reckless fighting. See, in FMCG paints adhesive, nowhere there is a low competition. So high competition will continue, but it will be a more healthy coexistence rather than just reckless competition. Going ahead.
Okay. ITC will be reporting numbers later today. Quick expectations here.
Yeah, ITC, clearly this is going to be the first quarter of such sharp increase in taxation. So overall volumes obviously will be weak. We saw that in VST Industries, just 3% volume growth, Godfrey Phillips, versus earlier trajectory of 25% kind of volume growth. It has cooled off to only 6%. So there is an impact there. On profits, if you see, VST and Godfrey both have done well on the EBITDA, but I think that is more of a Q4 one-time event. I think in Q1, all cigarette companies will see volume slow down. There will be margin pressure because companies have not passed on the full taxation in Q1. It's happening in a staggered manner. My sense is from Q2 is where the slight recovery on the margins will happen. Yes, tobacco raw material is favorable. Plus, agri business for ITC will be under pressure in March month because of the Iran crisis, and that will be in Q1. So ITC is still more of a 1 year, 2 year where no tax hike will happen, but next 1 or 2 quarters numbers will be weak. But Q4, my sense is company could do well on profits, as we have seen in VST and Godfrey also, because of the one-time taxation change, etc. But Q1, the margins will be weak for ITC. So more of a wait and watch approach rather than that. So our topics in FMCG will remain the same: Nestle, Marico, Tata Consumer. We also like in the discretionary space, Pidilite and Asian Paint and Berger Paint. It's a long list, but we are seeing consumption recovery across the board. Price hikes are happening 3 to 5% in FMCG. Paint companies have taken double-digit price hike, and Pidilite has also taken 13 to 14% price hike. So it's a good year for most of these companies, but definitely ITC will be slightly lower in pecking order.
Yeah, you got to wait, but you get paid. You get paid to wait. That nice dividend, right?
Yes,
that's the
dividend will be good.
Dividend will be good. Anything else in the fringes of your the FMCG, of course, is the core, but in the fringes of your coverage universe, anything else stands out in an absolute return candidate?
I think yesterday Metro reported good numbers after a few quarters. I think that could give absolute upside. They are also talking more positively on the consumption. So we are seeing broad-based consumption. Everyone is talking positively. Even for Page, we are quite positive. So I think these two companies offer re-rating potential also in the slightly retail discretionary space.
Okay, Avnish, we'll leave the conversation here for now. Thank you very much for joining in. You know, Prashant, there was an interesting note HCL Tech put out on the exchanges yesterday, where they surveyed 467 senior executives who are responsible for AI investments across enterprises whose top line or revenue is more than $1 billion. So fairly sizable, mid-market to on the larger side. And their report is saying that 43% of the enterprise AI imperatives or applications are going to fail. It's not, and companies are trying very hard. So it's not on account of lack of experimentation or access to tool, but it's just difficult to translate the ambition into enterprise-wide outcomes. And time is running out. Increasingly, companies want to see the outcome in the next 12 to 18 months. So there's sort of a, there are two issues. One is you're not getting the returns in the time after making the investments in the time that you have in mind, which is about 18 months. And secondly, you're not getting those enterprise-wide outcomes that you expect in that time frame. So 43% of the enterprises.
So this is comments from these guys themselves.
Yes.
At
so
these
HCL Tech conducted a survey where they interviewed more than 450 senior executives.
Which means that some of these guys have done this implementation and spent the money 18 months back. 18
months back, or they must be in the process, in the journey, and maybe they're not seeing light at the end of the tunnel immediately.
I see.
Or step-by-step progress. So it's an interesting, because we keep,
that is why there is what OpenAI deployment company and Anthropic deployment, whatever. I mean, it's and I guess some of these companies are the foundational companies are realizing that, right? There's a big difference between I mean, you and I use, and everyone, consumer side usage is very high, but enterprise usage is still not high. And
Still not
that's the
very
gap
high.
in that sense. Well, I think we'll put out some of those points from that HCL Tech surveys Rima said in a bit from now. Well, Sudarshan is back with us, and so is Mitesh with 9-10 calls. Sudarshan, what do you have?
It's Jubilant Foods. Buy Jubilant Foods with a stop under 465.
Okay, Jubilant Food. And what about you, Mitesh?
I'll go with the buy on Emphasis. I think that's the stock. IT is rebounding, and that's the stock which could do well.
Got that. So that is Emphasis. Let's just look at the rupee as well, right? I mean, we talk about the rupee when it's down. We should talk about the rupee when it's up and it's starting strong. So there is the currency, 96.4075. It's about a 0.4% pop against the dollar. It is broadly, the oil relief from last night spilling over into other asset classes. US rates, equities, and I think emerging market currencies. Rupee has, of course, been one of the weakest in Asia in that sense. So it's coming up. And, of course, a little bit of help from the Reserve Bank with that swap facility yesterday, which came through, which was announced. Well, Sammaan Capital, let's move on with more names now, right? I mean, announced numbers. So they did that fundraise, and now they've done the earnings, and perhaps the stocks up 4.5%, interestingly, by the way. So let's contextualize the numbers and the impairment they've taken. Ananya is here. Ananya, take it away.
Well, very interesting quarter for Sammaan Capital. We can say it was a more of a reset quarter that could redefine the franchise. Now, when we look at the numbers, they reported a loss of around 8,000 crore after aggressively cleaning up their legacy book through ARC sales, write-offs and provisions. Now, NII also remained weak. We can see the finance cost of nearly 16,079 crore exceeding interest income of around 1,000 crore. But the management mentioned that this will be the end of the cleanup era. Now, backed by $1 billion IHC's investment, Sammaan Capital now claims that their 53,000 crore AUM carries effectively no GNPA or NNPAs, and all the three rating agencies have upgraded their rating to AA+ within 50 days. Now, the big story here, the main catch here is the cost of fund. The management expects 150 to 270 bips reduction over time that could gradually improve the profitability going forward. Now, when we look at the guidance, they remain very aggressive. Targets of 2 lakh crore AUM, 4.4% ROA, and high teen ROEs by FY30. And while the few quarters will be very critical for proving NII recovery and sustained profitability, the management message is clear that the worst is now behind them, and we can see if the execution remains disciplined, Sammaan Capital could emerge as one of the more interesting long-term turnaround stories in the NBFC space.
It's about 0.8 times book, I think, Ananya. And, the logic simply is that they've taken everything. It's like it's a kitchen sinking exercise. They've taken the hit, they've cleaned up everything. All the pain is kind of sort of out, flushed out. As the environment improves and valuations are on its side, and as the environment improves, maybe this one does well from here. So we'll see. And of course, as I said, 10:15, you'll hear that conversation with Gagan Banga come up in a bit from now. Well, JSW Energy, QIP is the news, and Vivek is here with details. Vivek, morning.
Well, good morning. The fundraising spree across JSW Energy continues. A couple of days ago, they sold close to 3,150 crore worth of stake in JSW Steel. Now today, they've gone ahead and launched a QIP to raise another 4,000 crore rupees. Indicative issue price at a marginal discount to yesterday's close at 525 rupees a share. When you're looking at the equity dilution, is up a little over 4% of the post-issue outstanding equity capital. Interesting to see what the proceeds will be. If you assume that these proceeds will be used for debt reduction, then that meaningfully reduces the debt and will help net debt to equity go ahead and stay below the guided 5.5 times net debt to EBITDA.
Thank you. Thank you very much for that. Just counting down to the open, it will be a positive start, 170 points up in pre-open, aided by the decline in rupee, the cooling off of the bond yields, and the fact that the rupee has opened much stronger against the dollar at 96.25 now. So it's only getting stronger, open at 96.3 and now 96.25. So prepare for a gap up.
Prepare for a gap up, and we'll see if the gap up holds by close. That's the important thing, because you don't want it to fizzle out. I think, last few days, there has been a bid at lower levels. Markets bounced. So let's take it one day at a time for now. 170, 180 on the Nifty. So 23,846. The sensex is up about 600 points. The Nifty Bank is up 1. The mid-cap index is up 0.9. And it's looking good. 4:1 in terms of advances to decline ratio. This is, of course, right out of the gates. It'll change. Actually, I'm not sure if this has changed yet this morning for the first time, or this is, yes. I think this will change in a bit, yeah. 1666 and 275 right there on the NSE advanced decline ratio. So it's a good start. Mid-cap index is up almost 1%. The small-cap index will come up, and I think there is some gains there as well. The Nifty 50 heat map gives you a quick sense of where we are starting, and then we'll pick it up from there. So you've got ONGC and TCS. Oil's cooled off 5%. ONGC is down, and TCS, Infosys, and some of the others on one end. And Grasim and BEL and Indigo, Shriram Finance, Asian Paints are some of the big gainers that you have going at this point. Rima.
Well, Grasim is your big gainer. It's a fresh 52-week high on that. As it comfortably consolidates above the 3,000 mark, Nuvama has upgraded it, and they are saying that they expect improving operating performance amid sustained market share gains for the company in the paint business. BEL is recovering some of the losses from yesterday. The company has guided for 15% top-line growth in FY27, 2.5% up on that. The cool-off in crude prices has given wings to Interglobe Aviation, so that's taken flight 2% up. Let's see whether the calmer skies continue to prevail for Interglobe Aviation. Paint companies too are higher. Again, the same narrative. Crude prices now at $105 per barrel. Asian Paints up and about. Apollo Hospitals is reacting positively to its numbers, as Ekta was telling us. Eternal, Shriram Finance, L&T, SBI, Eicher Motors. These are some of the big movers. Reliance Industries has opened up on a more tepid note. It's a gain of about 0.5%, but continuing in the green. Just two Nifty stocks in the red. One is ONGC, again linked to crude, and the other one is IT. IT had a good run over the last 3 trading sessions, and today the leadership baton has passed on to the other sectors. But 150 points up now on the Nifty, Sensex up 500 points, mid-caps outperforming, and the advanced decline ratio 6:1. That's the start we like.
Well, that's right. But just take a look at a few stocks in the broader markets. Jubilant Foodworks, no pizza out here. That stock has taken it a hard knock. It's down 6.5%. So big downtick is what we're seeing out there. EPAC Durable, well, that stock as well is down close to 10%. Massive downtick out there. The revenue degrowth is 8% on a year-on-year basis. The RAC segment, the revenue degrowth there is close to around 25%. So that's why, in fact, that stock is taking a sharp knock in today's trading session. Ola Electric, well, not very electric reaction today. Remember, yesterday the stock as well came off the high of the day, and today it's down. The last quarter was a washout. However, the management commentary indicates there could be a recovery in quarter one. For the time being, the street is not buying into it. The stock is down close to around 5.5%, and volumes are very, very large. Let's run through some of the big gainers, though. Lenskart, initially yesterday there was a bit of a downtake, but the operational performance actually looked quite good in terms of growth, in terms of margin expansion as well. And that's why I think Lenskart is up close to around 1.5% on large volumes. Sammaan Capital will be hearing from Mr. Gagan Banga in just an hour or so. Well, that one in fact is up and about. It's flying away, up close to around 8%. Well, a few more gainers. Protein E-Govern, just take a look at that stock. Revenue coming at around 300 crores. That compares with around 220 crores. Which is, a big growth of close to around 39%. Even on a sequential basis, it's up close to around 35%. The EBITDA number as well has more than doubled on a year-on-year basis, and it's up 20% on a sequential basis. That's taken the margins to around 12.35%. That's higher year-on-year, but a little lower on a quarter-to-quarter basis. For the time being, bombastic reaction out there, stock flying away. J&K India, another stock that's moving on high volumes. For this quarter, the revenue has gone to around 340 crores. In the past quarters, it's been a ballpark around 190 to around 200 crores. That's the comparable number. J&K India is the stock that I'm talking about. The PAT number has more than doubled on a year-on-year basis, on a sequential basis as well, much higher. And the profit number as well is looking good. They're sitting on an order book of around 1,750 crores, and they've almost turned operating cash flow positive. So that one, in fact, is up. And Jai Bharat, yesterday, in fact, the stock was up 10%. Today, it's seeing follow-through buying. That one as well, up 13%. Small market capitalization, only around 1,300 crores. But big up move, 35% in this week, guys.
Well, it's a great start. It was a greater start, I should say, right at the word go. and it's up 120 now, so it's 100. So let's see. As I said, I mean, you know, how you start, of course, is good, but how you end is maybe even more important. So we'll see. And I think a lot of it, of course, will depend on external all these statements and what happens, and are we any closer to opening the Strait of Hormuz, etc., etc. So that kind of thing. So we'll watch this. 23,700 and 68, 69 is where we're at. Lots of stuff going on as far as single stocks go. Dollar rupee behaving itself with the rupee appreciating. Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini, good morning. Good to have you with us here. Thanks for joining us. So there has been so much, if I can use the word dispersion, right, with some stuff getting hit, some stuff continuing to do exceptionally well through this period since oil prices have spiked. Where are you seeing these opportunities lying? You know, one thing we've completely put on the back burner is this India-US trade agreement. We have US Secretary of State visiting later this month. And we don't know if before that they'd want to, prime up a kind of a framework agreement or some such thing. But we'll see. But are you seeing anything out there with where things have taken unusually large hits, unwarranted in that sense?
Morning, Prashant, and thanks for having me here on the show. The very interesting part, like you pointed out, is the disparate move in individual stock prices, despite the macro news being fairly sobering, including the weakness in the rupee and fall in the FX reserves and inflation prints and so on. So my sense is that the low that we saw in early March led to a lot of stocks getting beaten down quite significantly, where valuations have become quite attractive. And now, as the earnings reports are flowing through and the management sound constructive, notwithstanding the challenges on the global front, stock prices are sort of reacting to those commentaries and to the numbers. This is a very much, bottom up, individual opportunities, top down, nothing to get very excited about kind of a market. Something that, India has often seen in the past. I mean, whether it was say 2018 to 20, or it was 2011 to 13, or it was, a long period between, let's say, 1994 all the way till 2003. So, it's a bottom-up stock selection market where valuations are cheap, earnings growth is showing up. You'd better buy because, the stock prices ultimately reflect what's happening to earnings. Coming to the trade agreements, let's see what comes out of that. I think, on a medium-term basis, I'm fairly constructive about the effort that the government of India has put into trade agreements, including the FTA that was signed with the UK, which should come into effect pretty much soon. What's happening with the US and hopefully, the putting into effect the EU trade agreement sometime later into 2026 or maybe in 2027. So, that will obviously give wings to India's exports wherever we can. And I think that will be a positive that the market seems to be not focusing on at this point.
Ashwini, so, it's all about bottom-up ideas now. So do you want to tell us at least one sector where you're very bullish on, which could be the theme to ride from here on? Valuations are still reasonable, there is earnings growth, and one sector which you will completely avoid?
Morning, Rima. I think the private banks. Private banks are very attractive on valuations on a 5, 7, 10-year basis. They are now trading at valuations which you saw towards the bottom of the COVID lows. With credit data picking up, you will see an improvement in credit growth. Deposits are a challenge, but rising rates also help spreads in the short run. So I think, asset quality continues to remain very benign. So earnings growth is the story here with very reasonable valuations. And I think that's one area where I'm reasonably positive about. Now, you're not going to make like gangbuster type of returns, but you'll make, say, 18 to 20% a year with the frontliners and maybe a little bit more with smaller names. And that's not a bad return to make in a market which is going nowhere. The other area, which is a new one for me, is the FMCG names. I mean, they are actually indirect inflation plays. So what happens in a lot of the FMCG companies is that prices go up as raw material prices and energy costs feed through. But as the input costs normalize, the price cuts don't happen. So with a lag, you will see margins increase. In the short run, you'll see faster nominal revenue growth as inflation gets priced in, and medium term, you'll see faster earnings growth. So, that might be an area that investors can look at. Valuations are punchy there for sure. But I think, this is an environment where earnings growth and top line growth will get rewarded, given how difficult, the earnings environment remains. So those are the two areas that I would look at. I'm not a huge fan of themes. So, the themes that have been have been in focus for the last couple of years are AI, defense, and so on, where valuations are completely nuts. I mean, 100 times, 150 times, stuff like that. I mean, I can't palate those. I don't have a palate for those valuations. And generally speaking, anything that is hot, so to speak, and has excessive valuations is usually a source of frustration over medium-term investing. And that's the stuff I like to avoid.
So no defense in India and in AI, because we don't have those pure hyperscaler type AI names. I presume you're talking about the data center, the companies which are linked to the data center play, because you said valuations are completely nuts here.
Yes, absolutely. So I don't want to take any names, but yeah. And defense, there might be a few things out there. But, a lot of the stocks are very, very expensive that have already reflected the so-called defense play, notwithstanding that they are not direct plays and they're indirect plays for the most part.
Hi, Ashwini. Good morning. Good to see you, Ben. I didn't hear anything about tech. What about the tech names? A lot of pessimism on those names. One argument is well-run businesses, good cash flow yield. They have good amount of cash. They're doing buybacks. The other argument is why to buy? There's no growth. There's so many headwinds. Which camp are you in?
So Nigel, we've actually been doing a lot of work in this area, and it's a function of how much deflation do you see on the top line, and how much of that can be offset with higher rates for consulting type assignments on AI and costs saved by not recruiting at the bottom of the pyramid. We've come out a little bit constructive, though, due disclosure, we are working on this and I don't have any exposure here. I haven't had any exposure to IT services in a long time, but I think it's looking interesting. I think the tailwind from the weak rupee, I think the net kind of balance tilting in favor of earnings turning positive with that aspect, as well as I think, there will be some migration on AI that will require support from IT services companies. So I think the next few years are assured. After that, we don't know. So the terminal value is in question. But right now, given the underperformance, given the valuation support, given the rupee tailwind, I am getting a little constructive.
But as of now, you have no exposure, you said.
I don't have any exposure. As I said, I've been working on this last week, trying to get our heads around the problem, and let's see where we show up.
So incrementally, if you have 100 rupees to invest right now, Ashwini, how would you do it?
I think, Riva, there are a lot of bottom-up ideas. I mean, I mentioned private sector banks. I mentioned FMCG. I'm working on IT services. There are a lot of places in the mid-cap, small-cap world which are going a-begging. They're not sector-specific. And I think one has to dig deep, figure out where the earnings growth is showing up, where the balance sheets are strong, where you trust the management, and take individual exposures. I don't think this is a market which is a broad brush sectoral market, barring 2-3 areas that I see, which I've spoken about. I think it's a bottom-up market, and that's how I want to play it. And there are plenty of places. Actually, again, if you look back over the last 18, 19 months that we've been in the doldrums, there are plenty of names which are down 40, 50, 60, 70%. And I mean, if those businesses are not dead, and let's assume that, in September 24, maybe they were expensive. Today, they would be cheap. So, I think you have to look among those fallen stocks and see where you find comfort. That's how I think about it.
All right. Ashwini, where are you in terms of the metal stocks? One school of thought is you've already seen a big run-up, but the other school of thought is that, in fact, these stocks, there has been very, very low focus on capacity addition. And suddenly now you have some capacities that have got hit as well. Also, if you look at the way precious metals have moved up, industrial metals have, lagged them by quite a mile. And now there is that call that maybe, in fact, there'll be a bit of a catch-up. Do you expect a melt up, or do you think it's run its course, the metal stocks?
So, Nigel, again, in the Indian context, when you look at India, what metals do you play? I mean, the big sector that you can actually play is iron and steel. And that is one sector, unfortunately, where the arguments that you spoke about don't really apply. I think demand for steel will continue to be quite robust, but there's enough supply, and I don't see how a global AI theme or a reconstruction theme can help cement. So can help steel. So let's leave that one out. Copper, aluminum, lead, zinc, these are some of the things that we're talking about, copper being the hottest of them. And copper, there's no real play in India in terms of ore, barring Hindustan Copper, which I don't own. I tend to avoid government-owned companies. And in aluminum, I think there might be something out there. But again, there's no significant capacity addition coming up there. So how do you play growth purely on price is the question. So I have tended to avoid metals in my investment portfolio because I find these to be large global themes, very difficult to forecast, too many moving parts. That's been my historical, bias. And I tend to stay with that. And my sense is that, look, I need maybe 25 names in my portfolio, and I can find them elsewhere. So why bother? And that's, unfortunately, that's the stance I'll stick with.
Ashwini, we leave the conversation here. Thank you very much for joining in. We've got so many managements to chat with to talk about the FY20. Thank you once again. Okay, moving on now to IRB Infrastructure, mixed set of numbers. Net profit up 38%, but revenues have fallen 10%. The company is targeting a 25% CAGR growth in profitability for the next 5 years. Anil Yadav, CEO of Business Development and Investments at the company, is now joining in. Anil, morning, Rima here. Let's begin with the toll revenue guidance for FY27, because Q4 was strong, 21%. April as well looks very healthy. What will you do for the full year in terms of toll revenues?
For FY27, we expect almost 27% kind of growth in our toll business. And in spite of so many issues, in the month of April, we have seen a 24% healthy growth in terms of the toll collection. We have started a Ganga project from 17th of May this financial year. That will also add to our toll revenue. We expect more than 20% growth in our toll business for FY27. And even if I will just touch upon the like-to-like traffic growth, though we have added some asset and growth was around 24%. But if you look at the April, like-to-like basis, the growth was around 11%. And if I remove 2 to 3% kind of tariff revision, around 8 to 9% was the traffic growth. Considering the India's domestic consumption, the traffic remains robust. We have seen a very healthy growth in terms of the traffic.
Okay. Sorry, you said the FY27 guidance is 27% or 20% plus?
More than 20% plus, yeah.
Okay, and on an organic basis, because as you said, you've added on a lot more, highways like the Ganga one.
I think on organic basis, though we have seen around 11% growth, this year the tariff revision was around 3%, and we expect around 5 to 6% kind of traffic growth. So around 9 to 10% is the revenue growth on organic basis. And plus, considering the asset addition, there will be a more than 20% growth in terms of the toll business.
Okay, all right. Hi, Mr. Yadav, good morning. Good to see you in. The other issue, not just for a company perspective, but for the industry has been this labor shortage issue. There were elections, a lot of the labor went back to vote, and some of them haven't returned. And besides that, this spike in input costs, availability of gas has forced a lot of labor to go back to their hometowns. Are you experiencing something like that? If you have a number, what was the labor situation, say, a few months ago? And as of now, what is it?
So as we have asset base of more than 94,000 crores, but fortunately out of that 99% is almost complete. So we have not seen, since the construction is almost 1% left. So wherever the construction going on, we have not seen any kind of shortage to begin with. In terms of these assets, we have to do operation and maintenance. And operation and maintenance is only 15% of your revenue. And typically the inflation provides the hedge. We have seen an increase in the raw material prices, but considering it's only 15% cost of the revenue and your revenue increase on the basis of the inflation, so that acts as a natural hedge for us. We don't expect there will be any impact on our margin. But as of now, with respect to whatever the little construction we are having, there also we have not seeing any kind of challenges in terms of labor or even availability of the material.
Got that. The NHAI bidding, has that been a little muted? Are you seeing a pickup going forward? And what is your monetization pipeline?
I think in terms of the NHAI, if you look at the historical also, typically the second half remains quite robust. And from the budget, the government has announced a monetization of 3 trillion. That during the year, the government has increased to 4.4 trillion for the monetization in the road sector. And that will be monetized over the period of 4 to 5 years. So that provides a good visibility in terms of the company like us, where we have almost 40% market share in the TOT business. So that we will be continuing to bid for the TOT project. On selective basis, we will also eye for the viable BOT opportunities as well. Now coming with respect to the monetization of our asset, we have already, the NBO is issued from the private InvIT to transfer 2 of asset, where the equity unlock will be around 2,700 crore rupees.
Okay, all right. Mr. Yadav, final question before we let you go. I'm looking at your order book. It's around 42,800 crores approximately. What's the inflow you're looking at and what should you end this year at?
I think since we have guided that we will be reaching to 1,40,000 crores at the beginning of FY26. During FY26, our asset position towards the end of FY26, we have reached already 94,000. So around 10 to 12,000 crores kind of asset addition every year we will be doing from here on. That will be a mix of TOT and very selective basis on a viable BOT project.
Mr. Yadav, the missing link project, which is a part of the Mumbai-Pune Expressway, did you all construct it? And now the traffic is getting diverted. Will there be any impact on the old road, the old Mumbai-Pune Expressway? And can that be a problem?
I think that's a positive for the company. We have not constructed that. That was done by the authority. Now, with respect to the traffic, the NH4 and Expressway, both is tolled by us. And in the hilly terrain, that is the Ghat section, both the road used to converge to one section and there used to be a lot of traffic jam. And that's why the Mumbai-Pune, the growth was a little softer. But after missing link, the congestion will be over and there will not be any kind of divergence since both the roads are tolled by us. It will be a kind of easing of the traffic. We should expect a better traffic growth in coming months.
Okay. But where do you get tolled? You get tolled before?
You get tolled before.
Before. Khalapur is the tolling point and that basic link is for the Ghat section where both the road used to get converged. In between, there is no toll.
I see. So you don't have to go the up and down on the Ghats basically.
Yes.
I used it. I was actually fabulous. Yeah. Okay. Saves about 15-20 minutes straight away. But your point is well taken. It's not that it's avoiding any toll, so it should be status quo for you, no impact. But thank you very much, Mr. Yadav, for joining in. That's IRB Infrastructure guiding for a 20% revenue growth. By the way, there's a very, very powerful rally underway in the Asian markets. Kospi is up 7.5%. You've got a 3.5% rally going on the Japanese market and the Taiwanese market. So it's looking up. For the Indian markets, the gains are a little more, it's there, 100 points up. But we started off with a lot more flourish.
All AI.
All AI.
I think, I don't know if there was an NVIDIA call after, maybe there was, right? Post, and maybe they've said something, I don't know. I mean, There was that parabolic demand phrase which was used.
Yes.
And who's going to feed all that demand? It's going to be all
In
these companies
aftermarket,
there.
actually, Nvidia
was down.
Was down
Down a little
2%.
bit.
Down 1%, 1.5%.
And the point on Kospi, it was around 8,000 a week ago. It corrected to around 7,200 and it's back at around 7,700. So it's pulling back some of those losses, actually.
All right. Well, Apollo Hospitals is the next company on our radar. They reported numbers, strong set for the fourth quarter, beating street expectations across all parameters. Also in a major strategic move, Apollo's maternity and fertility business are set to merge with Cloud9. To discuss this and more, we have Sunita Reddy, Managing Director at the company, with us. Ma'am, thanks very much, as always, for joining us. I want to start with something. Maybe it's a little bit of nitpicking, but I want to start with that. There is a 40 basis point EBITDA margin contraction in the hospital business. Could you start there? What happened, ma'am?
So in the hospital business, we opened out 780 new beds in this year, in the year that passed. And I think the losses from 4 of the hospitals contributed to a contraction of 100 basis points.
Yeah. What would this? So this will normalize. I mean, this was expenses basically.
Yes. So this will normalize, but I have to say that our established units were at 25.6% EBITDA margin, and because of the new hospitals, we saw this coming down to 23.8%. But going forward, we will continue to open new hospitals. So I think in terms of guidance, we should look at revenue growth, a strong cash flow that is emanating from established units as they get, occupancy increases and volumes increase, and new hospitals adding to both revenue and volumes.
Got that. On the newly commissioned units, there was a 270-bed unit in Kolkata, which was commissioned, I think, in the last quarter. A 400-bed unit in Hyderabad commissioned in April. Could you give us some outlook on these? How fast will these be? Will these break even? What's the timeline?
In 1 year. They should break even in 1 year.
Okay. And in terms of the number of beds added, operationalized in FY26, what was the number and what do you expect to do with this year, FY27?
So 80 beds were added. We operationalized about 50% of them, and we'll operationalize the balance this year.
Number, ma'am, what is the number for 26?
780 beds were added.
I see.
We operationalized 50% of them, and we've started to operationalize the balance starting from this quarter. In addition to that, we are adding another 850 beds, which will include Gurgaon. So there is a strong bed addition pipeline, which will contribute to revenue growth.
Good morning, Rima here. You've also announced plans to merge the maternity and fertility brand, Apollo Cradle and Fertility with Cloud9. Can you take us through the strategic rationale behind this?
So in this transaction, first, we are the only strategic investor with the 9.9% holding. We also get 750 crores of cash in hand. And this cash in hand will be used to develop the primary care network, which I think is a huge differentiator from the rest of the healthcare players. This primary care market will include investment in diagnostics, in building out the clinic network that will serve primary care. As you know, we have over 232 clinics. We've just added another 10. And we believe that with this, and we have a diagnostic network of 2,501. So, and a growth of 52% in this space. So this money will be used to grow the primary healthcare network. However, the hospitals will continue to do the mother and child hospital work, which we are very good at, and we will set that up in all of the Tier 1 cities. We already have 2, and we'll continue to grow that space.
And you will stay a passive financial investor with a 9.9% stake in this entity?
Well, we actually know the business and are strategic in nature as opposed to the other investors.
Yeah. Ma'am, any outlook for your own business? I think this, your business here did, I think, about 100 crores in income and about 15 crores in losses. How is this looking? What's the outlook here?
Which business?
The fertility business, the cradle and fertility centers.
No. So the cradle and fertility will get merged into Cloud9. And once it's merged, I think the whole entity will definitely be the largest. They say the largest in the world. So we believe in scale and size. So that will benefit both us as strategic investors as well as Cloud9.
Okay. On Apollo HealthCo, you all achieved your first full year of profitability. In Q4, margins were 5.5%. So what led to this improvement, and what can you guide as sustainable margins for FY27?
I think the huge growth in, first of all, in revenues. They had revenues of 2,832 crores, representing a 21% growth. So, and this came with 156 crores of EBITDA and 107 crores of profit. So clearly, the numbers, the revenue, the performance of Apollo HealthCo is looking very good. In that, the offline pharmacy did very well with revenues of 2,518 crores and an EBITDA of 195 crores with a 7.7% margin. So, and network addition of 176 pharmacies. So there is huge growth coming from the offline pharmacy space. Private label also grew to 15.2%. So the margins also came in at 7.7% with this growth. In the digital also there was growth. They had about 330 crores of revenue. And net, the margin of the Apollo HealthCo came to 5.5%, which is a healthy margin. And I think in terms of profitability and, the fact that it's growing, GMV grew to 528 crores. Insurance business, GMV at 16 crores, but huge potential. So this is definitely, it's growing both in the physical format as well as in the digital format, and this is leading to higher profitability. They ended with a loss of 16 crores. It was 36, but if you take out ESOPs, it was just a 16 crore loss for the digital business.
And the scale-up of the digital business, as you said, right? Apollo 24/7 had a GMV of a little more than 500 crore in Q4. For FY27, what are you particularly expecting on the profitability and the top-line growth?
The top-line growth will continue beyond 25%. I think they have strong revenue streams, which is why I think the move to profitability is very, very important. So while top-line is good, we've always said that profits are give you more comfort. And in that space, they've really curated their offerings in a way that they are both revenue growth. You will see revenue growth as well as profitability rather than focusing on GMV.
Ma'am, last few interactions, whenever you've been on, I've always asked you, any movement on Indraprastha medical situation?
Some things go slowly, and I think it's summer, so probably ports are closing. Post that, we continue to be optimistic, and I think we've also declared that we've won a plot of land, 10 acres in Dwarka. So we have very strong plans to grow our presence in the Delhi market with at least 3 hospitals in Delhi and 1 in Gurgaon, and a network of clinics that will surround each of these daycare centers and clinics that will surround the city.
Okay. So, the courts will open, I guess, first, second week of June.
Yes.
So, post that, we should see some movement?
Yes, you should see some.
Ma'am, you said on the Dwarka front, is this basically saying that even if you're not able to move ahead with this and increase stake, you'd be happy expanding in the region, in the area, without necessarily...
Of course.
Yeah.
Of course.
Right.
I think we have very good doctors. We understand the market. And we will create a network, not just hospitals in Delhi.
Okay. But you are very focused on going up with your holding in Indraprastha. That remains, I mean, there is no... You're not backing away from any of that. It may take time, but
there is no backing away from that.
Okay, got it. Thank you very much, ma'am. Appreciate it. We'll chat again. And good luck on Apollo Hospitals and what you're doing out there, the business, and of course with some of the other stuff like the fertility business, Cloud9, and of course Indraprastha Medical. We'll keep track. 126 points on the Nifty is what you have. Nigel, Samvardhana Motherson management with us.
All right, they've reported a good set of numbers. Except modules and polymer, all segments have seen a double-digit growth. The debt is down by nearly 2,000 crore. We have with us Gandharva Tongia, Group CFO of the company, joining in. Thank you very much, Gaurav, for joining in. You did indicate that Q1 could see a higher impact on account of copper, polymer and freight inflation due to pass-through with a lag. So just for the near term, what is the kind of margin pressure should investors realistically expect before recoveries start flowing through?
Thank you for having us and good morning. You are right. This was best ever performance in the history of the company. We were able to achieve a top line of 1.25 lakh crore. On your question on inflation and commodity prices, in our businesses generally, if there's a change in commodity prices, we are able to pass on to the end customer, albeit with a lag. So we believe that over the period, we should be able to maintain our margins. As far as other inflation costs are concerned, those are matter of negotiation and discussion. Generally speaking, give and take, we should be able to recover those costs as well from the end customer.
Of course, we were just trying to assess in the near term, in Q1, what will be the impact? Is there a number or a range you could give us?
Let me explain the business to you. In the case of copper prices, our arrangement with customer is to pass on the increases between a quarter and two. And therefore, if we were to take an annualized view, we don't expect that margin will have significant impact. It's quite possible in a quarter or two for the temporary reasons, there is some softness in the margins, but if you were to take annualized view, it should not have a material impact.
Got that. The consumer business achieved EBITDA profitability in FY26, and now GF3 is expected to drive the next phase of your scale-up. When do you expect the electronics business to become, to contribute meaningfully at the consolidated EBITDA level? What time and even the number?
You are right. Our non-auto business is a reflection of our DEML capabilities, design, engineering, manufacturing, assembly, and logistics. This was the first full year of our consumer electronics operations, and team has delivered a stellar performance. The top line grew by 7.5 times between FY25 and FY26. We believe non-auto businesses should have meaningful contribution over the period. Today, it's around 5%, consumer electronics and aero and other non-auto businesses put together. By 2030, we believe that this number will be meaningfully higher. But at the same time, the auto business will continue to grow. We want to achieve a gross turnover of $108 billion by 2030. So it's ambitious. We believe both the businesses will contribute to the growth of the organization.
So non-auto contribution by FY30 goes up from the current 5% to?
It will be meaningfully better, but at the same time, the auto business will continue to grow. So it's going to be a good fun to watch.
Okay. You don't want to share some numbers?
The top line, as you know, Seema, is 108, which is what we are targeting. And all of us are collectively trying our level best to achieve it sooner than later.
You've also mentioned the acquisition pipeline remains very strong. So are you looking to acquire in the non-auto side of business? Is the auto? Because now your leverage also is very comfortable to what the the threshold that you have accepted in the company that you can go up to. So is there an acquisition pipeline, and what are you looking at?
You're right, absolutely right. We would have done almost 50 plus acquisitions in the last 20-25 years. Your reading of balance sheet is absolutely right. We are at the lowest ever leverage ratio of 0.8x. our financial policy allows us to go right up to 2.5x. We have already done one acquisition last year, which has been consolidated at Summitech. We announced 2 more, which will be consummated in the first half of this year. As acquisitive company, we continue to monitor and assess wherever we have good opportunity, generally speaking on the BS of the customer. And we believe that we'll have meaningful opportunities in times to come. Whenever we have something closer to the deal, we'll come back to you with an update.
In FY27, is there going to be an acquisition?
I mean, that is what we do. That is what we have been doing over the last several years. Since last 20 years, we would have done almost 50% or plus acquisition. So we'll try our level best to do whatever is possible, even in the current financial year.
EV program is now 22% of your booked business, but only 11% of the revenue. Has there been any slowdown in EV adoption globally? Are OEMs shifting sourcing preference more towards hybrids and ICE platforms once again?
It's a mixed bag. It will differ from country to country, from consumer to consumer. It's also dependent on how countries are trying to promote EVs. There are a few countries wherein there's subsidy available. But as you know, Seema, ours is engine agnostic. We supply to all type of OEM customers. We can supply to ICE, hybrid, as well as EV. And that is where the order book is extremely solid. We have $96 billion of order book today. And we don't necessarily believe that any change in the color of the order book will have bearing on our performance. We'll get guided by what our customers want us to manufacture. We'll manufacture and meet their expectations.
Okay. Any demand impact in the near term on account of the war?
Generally speaking, not yet. It's quite possible there is some inflationary impact on the performance of the OEMs or the auto ancillary companies. But if we were to take midterm to long-term views, generally speaking, there is a growth which is possible. In the light commercial vehicle, the expectation is that the CAGR is going to be around 1.2% over the next 5 years. In the case of commercial vehicle, it should be around 3%. And most of the growth should come from the emerging markets like India and China.
Hi, Gandharv. Good to see you. Ben, you have that big aspiration, right? $100 billion of revenue by 2030. What's the biggest risk? $108 billion, apologies for that. What's the biggest risk for you? Demand, supply, competition? What do you think?
You're right. It's ambitious target. This is our 7th 5-year plan. We have achieved, our target in almost all the 5 years plan, except the one which got impacted by COVID. We have our arms and ammunition in place. We have our risk management in place. It's, of course, dependent on several external factors. But we believe whenever the volatility is high, uncertainty high, Motherson gets opportunity to acquire the businesses. This is what we have done over the last 25 years. And we believe in the next 3-4 years, we'll get enough and more opportunities to grow both organically as well as inorganically to achieve $108 billion of top line.
We'll leave the conversation here. Gandharv, thank you very much for joining in. That's Samvardhana Motherson. Stock is holding up with a gain of about 2%. For our own markets, Grasim is the big mover. Metro Brands, where the company is confident about that mid-teens revenue growth, margins around 30%. That's opened up higher, 3% up on that. Apollo Hospitals, the start was 1.5% higher, but post the interview, it seems to have a leg up. So that's pushed up towards a near 3% rally. On the way down, EPAC Durable is under pressure. Bosch is down 3%, and Jubilant FoodWorks hasn't seen any recovery in the first 1 hour, still down 7%. Get into a break. On the other side, we'll talk market technicals with Shilpa Raut of Prabhudas Leeladhar.
Welcome back. The market saw a bit of profit taking, but that dip has got bought into. So that's good news as well. And now that they are very, very crucial, the 50 DMA on the Nifty, if it comes up for you, we have just managed to cross that mark. Let's get in Shilpa Raut of Prabhudas Leeladhar, who joins us on the show. Hi, Shilpa. Good morning. Good to see you, Win. What's your take? We're good for more. The last couple of days, the dip has got bought into. Today, we have a gap up. Do you think we can sustain? And would you execute a fresh trade now?
Good morning, Nigel, and thank you for having me on the show. talking about the indices, we are at a very crucial junction. This 23,800 to 850 marks will act as a resistance. We need to have a strong close above this for any sort of upside. As long as we are not having that, we might see some profit booking again towards 23,500 zones. So little bit of turbulence here, so be cautious and stay light. And for Bank Nifty, again 54,000, 54,200 will act as a resistance. Close above that or a sharp sustenance above that will only trigger levels of 55,000. Otherwise, again 53,200 will come in. So I'm a little bit cautious on the long side now.
Okay, got it. What about individual stocks then?
Yes, individual stocks are performing quite well. So I have a buy in Angel One. Angel One is looking very strong with a stop loss of 330. You can stay long for levels of 355. The other one would be a buy in NAM India. NAM India is also outperforming. Keep a stop loss of 1100 and stay for targets of 1160 to 1180.
Got it. Okay, Angel One, what a move out there. Thanks, Shilpa, for joining in. A few months ago, the stock had hit a 52-week low, I think in March when we had the war that broke out. And from, I think, 210 rupees, the stock has moved to around 340 rupees. Just pull up a 3-month chart. Yes, bang on. It was around 210 rupees. So what a big swing. In a matter of 3 months, it's moved from a 52-week low to a 52-week high. That's a whopping 50% bump up that you're seeing on the stock. And actually, a couple of other names as well, like BSE as well, have seen a big recovery from those lows that we saw earlier this year. Well, talking about BSE, today is the Sensex weekly expiry that will play out. So it's going to be extremely important to keep an eye out on the volatility, particularly in the final hour of trade. You have the 75,700 call. Just take a look at that now. The premium's holding at a close to around 180 rupees approximately. It's not moved up too much, and there's a mix of activity that you're seeing at this particular level. I think today the bears will want to defend this 76,000, 76,100 odd mark. The reason I say it is because there are clear signs of writing at around the 76,000 call mark. Just take a look at the premium. You've got the direction right because the Sensex is actually higher. But the premium has come down to around 78 rupees from around 91 rupees or thereabouts. So there is writing on the upside that 76,100 just for the day appears to be the crucial mark. On the downside, you have the 75,000 put. Take a look at the premium. It started at around 140 rupees on. That was the close that we had yesterday. Now it's come down to around 28 rupees. So there is writing being seen out there. And the last couple of trading sessions at around that 74,500 odd mark, there has been some buying interest. So that's the reference point on the downside. If we can get past the 76,100 odd mark, then all eyes are on the 20 and the 50 DMA. That's a little distance away. But for the day, the 76,100 mark becomes a resistance on the upside, while at lower levels, around 74,800 odd seems to be a bit of a support zone just for the day. Weekly expired, remember, so you'll have things that will get a little bit volatile in the final hour of trade. For the time being, we slip into a short break. On the other side, Manisha Gupta is waiting for you. She'll tell you all that's going on in the commodity markets.
Welcome back. Shift focus now to the commodity markets. Manisha is joining in as always. Manisha, what are you looking at?
Well, I'm looking at the gold prices because overnight we've seen dollar index weaken a bit. Crude oil prices go down by nearly 5%. And that money seems to have rotated, well, yes, in equities, but also in case of metal prices there. So take a look at gold then. And we saw 1% of gains in the overnight market there. If you look at this year, we're up by nearly 5%. And in the last 12 months, we've seen 40% of gains now hold in case of gold and $4,500 an ounce back in case of that commodity there. Well, the latest clearly seems to be coming in from the US and Iran, where US says that they are nearing a final phase of negotiation with Iran. Iran also has said that it is evaluating the US's latest 14-point agenda and would be responding to that. The peace agreement between US and Iran could actually ease inflationary pressures. We could be looking at crude oil prices coming off a bit, maybe below $100 a barrel as well. And that would really mean that there would be a lower expectation then of a central bank needing to tighten the monetary policy, increase rates. Remember, at this point in time, there is a 50% probability of one rate hike coming in from the US Fed in the month of December. So that possibility perhaps would go away. No rate hike, no rate decline, but we could be looking at neutral, and that kind of works for gold therein. The rise in crude oil prices and the strength in US dollar in the very recent time has weighed in case of gold because the money was rotating in that areas and gold wasn't really behaving as a safe haven is the reason we saw some profit taking coming in. But then again, you saw the gold prices at all-time highs of $5,600 an ounce in the month of January. It was overbought by then, and some profit taking, some correction is what we actually saw. Going forward, the expectation is that you could be looking at support continuing for gold. One, because of central bank buying, which is more or less just about continued. Poland, look at China, 16th month of buying coming in from there. And then you have investment and retail demand quite on the stronger side. Mutual funds have been buying as well. The geopolitical risk will continue to do that safe haven buying support that gold usually thrives on. And then for Indian market, it's going to be even better in sense of gold because one, we're looking at weak Indian rupee and then higher import duty, keep the gold prices higher than what they has been in the other international markets therein. How are gold prices going to be from here on is what we are going to get on the board right now. So this is the year-end targets coming in from the major banks and brokerages. We are trading at 4,500 right now. By the year-end, most of these banks believe that we could be much higher in case of gold prices. 5,600 has been an all-time high, and that's exactly where the markets believe you could be looking at the gold prices coming in. Goldman Sachs has put its year-end target at 5,400, Bank of America at 6,000, JP Morgan between 6,000 to 6,300 as their best case scenario. You have UBS talking about 5,900 to 6,200, and then Wells Fargo says that 6,300 also is a possibility by the year end in case of gold prices. But there is a $10,000 an ounce club as well as far as gold goes. Well, there are 3 or 4 scenarios that the markets are working with that can take the gold prices to 10,000. One is if central banks increase gold reserves to 40%. And if there is a tectonic shift in gold in the global political system, you could be looking at the gold prices surging higher. And the third is if there is a massive rotation that we see from equities into real assets, tangible assets, in that case, gold could also be going higher. But let me put some names out on the names that are talking about $10,000 an ounce in case of gold prices. Ed Yardeni is one. He says the gold can hit $10,000 an ounce by the end of 2029. You also have Chris Wood saying that it is a possibility that you could be looking at gold at $10,000 an ounce in next 5 years. And then you have Peter Schiff also saying that 11,400 an ounce is a possibility if currency debasement accelerates. The other name that I want to get on screen is Jim Rickards, who says 10,000 level is a mathematical necessity that gold will see. Jeff Currie was the commodity head for Goldman Sachs. He says that gold could drop towards 4,000 in this year and erase all the gains in 2026, and then it would surge towards $10,000 an ounce. So almost everybody really talking about higher gold prices. 6,000 is something we've been talking about, but 10,000 club really seems to be getting bigger.
All right, Manisha, thank you very much for that. So that is commodities in focus there. We'll take a break. We're back. Well, I think very, very interesting conversation coming up next. Sammaan Capital, right? They had raised a large amount of money. Yesterday was a very, very important quarter. I mean, is the cleanup, the flush out of all the pain behind, and is this a new look Sammaan? The market would like to believe it. It's locked up 10% at this point. Latha chats with Gagan Banga of Sammaan Capital on the other side. Stay tuned.
Welcome back. As Prashant said, Sammaan Capital has prioritized quality over quantity. The company has used the fund infusion by IHC, about over $1 billion, to provide for legacy bad loans. So while its net income in Q4 is minus 574 crore and its net loss is 8,100 crore in the fourth quarter, its NPAs are down to 0 from 1.2% in Q3. The company is promising aggressive growth henceforth and also diversifying away from home loans to gold loans, personal loans, unsecured lending, loans against shares, etc. Joining me now is the MD and CEO, Gagan Banga, to explain the reset of the company and how they plan to take the AUM from 53,100 crore to 2 lakh crore in 4 years. Gagan, thank you very much indeed for joining us. Well, it's a big target you're giving us out there, but tell us immediately how will FY27 likely look? will your NII become positive? This minus 574 crore becomes positive in this quarter itself, Q1. And how will the profit as well look, or even the cost of funds look? Give us some details for FY27.
Sure. Good morning, Lata, and thank you for having me on the show and personally interviewing me. It's a privilege. Lata, just before I directly answer the question, to put in context the transaction and what we've tried to do, IHC is a huge company. It's the Middle East's largest investment company. It's extremely seasoned and has a lot of experience in turnaround stories such as Sammaan. So this playbook is extremely well known to them, and they've created hundreds of billions of dollars of value in their investee companies through such turnarounds, which they also articulated in the analyst call yesterday. I've also spoken about this, that when companies raise capital, they have two purposes. One is to create buffers, and the other is the sheer amount of liquidity which comes in. So firstly, we have used this opportunity to create the right kind of buffers, such that management, which had been fairly distracted over the last 7 years trying to tackle a whole host of issues, is firmly and finally able to say that the legacy book is closed. And that is the first message I would like to give you, that the legacy book is finally, formally, firmly closed. Second point, we have used this capital buffer to focus on what's the most important thing, whether it is for fiscal 27 or the years beyond, which is to move steadily, rapidly, and firmly in a direction of being the lowest cost of fund operator. So for fiscal 27, the most important thing to watch out is how the ratings, which in the first 50 days of IHC's investments have already been upgraded to AA+, continue to move up in the trajectory which is desired, which is the highest possible ratings, both internationally and domestically. The second point is we invest in what we know very well and go back to numbers which we've been capable of doing well in the past, which is mortgage-backed lending, and also invest in building the right kind of guardrails for anything new that we do. What we want to do now is very steady compounding, which should outlive me. And in order to do that, fiscal 27 would basically be testing out the new products, putting out technology. And there again, IHC's expertise and their tech ecosystem, the AI capabilities that they do, the passion His Highness has for AI, all of that is going to play a material role in what we do.
Gagan, may I interrupt, Gagan? We've gone through all this in your presentation. I want to know some numbers for FY27. Your investors will want to know, people who hold your shares. What is FY27 going to look like because of the rating upgrade? How is the cost of funds in first quarter versus Q4? What is the likely NII and likely profit, if there is, in FY27?
So to put that in context, our opening AUM's ROA, which is 53,000 crores, ROA is 1.6%. The savings by the AA+ upgrade from AA is going to be a minimum of 1.6%. So ballpark, it doubles the ROA immediately. On top of that, we intend to disburse a little over 30,000 crores, and that should take the book by end of next year. So this year, we should end with an AUM of over 70,000 crores. Next year, with an AUM of over 1 lakh crore. With the reduction in the flow of capital, I will have to slowly work with my lenders to redo the stock cost of capital. The cost of capital should come down by 120 basis points to where it is today on the entire stock. On flow, it should come down 160 basis points, and this should add up to profits of around 1,400 crores or a little above 1,400 crores this year. We would also start distributing dividends The guardrail around dividend that we set is at least 25%. The desire is to give out 40%.
Okay.
So we should net of all of this and the warrants which are coming in, add roughly about 3,300 crores to our net worth this year.
Yeah, those numbers are already there. I just want some new numbers from you. You said it should endure my time even after I leave or something. Are you not going to be there? I mean, after all, you have an excellent new recruit in Himanshu Roy, who is a turnaround artist in his own right. So are you going to hand over to him or something?
No, I'm here. They've come. They've also articulated that they are backing the management team. I am around. I am leading the management team. They're backing me. They see me as the CEO. By outlive me, I mean I am 50, so I will probably work for another 10 years. The compounding should go to 10, 15, 20 years and beyond.
Okay. Okay. Yeah, but yeah, at 2 lakh crore by 2030, it should be a 40% CAGR growth in 4 years. Isn't that a bit aggressive? Aggressive growth was what landed you all in trouble in 2018.
It is not aggressive given the size of the environment which we operate in. We were 1,30,000 crores when the GDP was less than half of what it is today. Even more importantly, I think what really calibrates the growth of a company is the sort of balance sheet borrowing, the liability program. About 30% of our incremental borrowings would continue via the asset-light strategy. Okay. So between the overall opportunity having significantly increased, the asset-light strategy, which has played out extremely well, and the tech-based centralized controls that we have, besides having the strong promoter. Even back then, if we had an institution as large as IHC backing us, we would probably be today 5 lakh crores. So it's a lot about the backstop that the market sees, and IHC, there isn't a larger backstop, at least in the Indian context, larger than IHC.
So Himanshu Mody remains only Deputy CEO.
Himanshu remains as a very capable Deputy CEO. He has a lot on his plate. And I think he's formally concluded that he was essentially very idle in his past jobs. Here he is extremely busy.
Okay. Coming to the reset that you all have done, even in 2018, you brought down, 2018, 19, I think mid-2018, you were 1.3 lakh crore. 2019 was the IL&FS and the NBFC problems. You all came down all the way to 73,000 crores by 2021. One reset was already done. Why did you have to do it again? That might disturb investors. Again and again a reset. Didn't you all learn lessons from 2018 to 21 would be some people's question.
So 18 to 21 really can't be seen as a part of a journey. 18 to today was part of the journey. 18 to 21, we managed to stabilize the company. And then we went through a whole overhaul process of depromoterization, name change, raising equity, and so on and so forth. Our business, and this is something that I can't emphasize enough, is a business which lies on the foundation of cost of funds. It's a liabilities management business. Unless you are the lowest cost of fund operator, you are basically running an arbitrage business, which does not last too long. If this business, as I said, has to go beyond the 5, 10, 15-year compounding and compound longer, we need to focus on cost of funds. What did not get achieved, certainly by 2021, was that our cost of funds were not declining. What did get achieved, and which is something that we will leverage, and this is very, very important, that between 18 and 24, we had, without a single day of delay, default, or causing trouble to anyone, paid back 130,000 crores. That's the foundation to our lenders. That's the foundation on which this transaction rests. Those are the laurels with which we go back to our lenders with our head held high, and that will along with the ratings and IHC, result in the lowest.
Now, Gagan, you have to keep your answers short because you're not getting enough time. One, have you borrowed at a lower cost in this quarter versus last quarter? Is there already evidence? How much? Secondly, you are telling us that you mentioned the current productivity is only 0.6 loans per employee per month. And you want to increase it to 2 loans. Is the current workforce underutilized? Why such a big gap?
Yes, the current workforce is underutilized. We have tactically ensured that the franchise stays intact, the team stays intact. Otherwise, why would anyone be investing in a company? An NBFC business or a lending business is all about people. IHC articulated that they've come to back the people. It is a people's business. If we did not even have people, what did we have really? We don't have a plant to show off.
The cost of funds.
As far as the first 30 days impact, the costs with, we had received only 1 rating upgrade in the month of April, and the costs were already down 100 basis points.
And do you expect any recovery at all from the legacy assets that you wrote off? I mean, give me some idea of what the NII and
for sure. We will get back at least 7,000 crores over the course of the next few years. Some of it is baked into these numbers. Some of it are the buffers that we are keeping on top of these numbers. But 7,000 crores is something that we have our eyes clearly set on.
Okay. And this year itself, your home loan will be how much and non-home loan will be how much? FY27 target?
I'm sorry?
In FY27, mortgage versus non-mortgage, what will be the breakup by the end of FY27?
FY27, almost 90% would be mortgage. FY28, about 70% mortgage. And then we would have mortgages at 50 and everything else at 50.
Okay, fine. Lots more questions, Gagan, but I would like you and Himanshu Mody yet again for more detailed discussions. Thank you very much indeed for joining us and all the very best to you.
Thank you.
Well, we have to wrap up on Bazaar on that note. Markets in a cheery spot. Let's hope that continues after a break. Chartbusters.